Hi guys. So as the markets are currently bullish, with Bitcoin's rally reaching an all-time high of over 123,000, as well as major indices closing at their third strongest close ever, having the S&P 500 rising to 6,280 and Nasdaq 100 hitting over 23,000. Quite an impressive rise from recent lows just about 3 months ago. Investors' confidence are high and traders are super excited as the market signals a good time to make some good profits. However, for some inexperienced and mostly beginner traders, they often fall into what is called the bull trap. Now, many are wondering when is the right time to jump in. So let's break down how smart traders time their entries in a bullish market without getting trapped. So please remember to like, subscribe and share and make sure this video gets at least 1000 likes. So without further ado, let's dive in. So first, a bullish market is used to describe a period in the financial markets when prices are generally rising and investor confidence is high. It signals that the economic state of the market is strong and higher gains can be made. And a bullish market is usually characterized by high economic growth, investors having stronger confidence in the economy and the market, and prices of assets generally, from stocks to crypto, are trending higher. And during this bullish period, economic production is usually high, there is plenty jobs, and inflation is low in an ideal situation. As you can see in this chart, the S&P 500 index has been rising from its low in April. And so, as prices are rising, it is generally assumed that prices will continue to trend upwards. But even in a bullish market, not every point is a good buying point, since the market experiences what they call pullbacks. That is, significant drops in price, which makes traders fall into what is called a bull trap. A bull trap is a false breakout to the upside that often convinces traders to buy and then immediately reverses lower to the downside, causing traders to lose money. Now, even in a bullish market where you can make bigger gains and so much money, you can equally lose money. And those who lose money lose because of some common mistakes like buying after a big green candle, which is most often caused by FOMO, fear of missing out, or they follow hype and end up buying at resistance instead of buying at support, or they ignore signals of a pullback. So they ignore things like volume and market structure. And all these could have been avoided if they had a trading plan and followed their strategy. And here are three proven strategies that have been used in a bullish market and have resulted in high win rates for traders. The first one is buying the pullback, which is also referred to as buying the dip or the pullback strategy. It involves waiting for the price to return to its support zone before entering. This strategy is designed to capture big moves during highly volatile trending markets and focuses on the trend continuing to the upside. So here in this chart, you can see price move higher upwards and then pulled back to test previous support level before continuing to the upside. And this circle point is where you want to buy, which is a good entry point. Because when you enter trade at this point, it gives you a better risk to reward ratio and allows you to trade along with the market momentum moving in your favor. The pullback is a temporary correction phase and usually drops by close to 10% or more from its recent high. And this strategy offers a high win rate compared to just entering trades randomly in an uptrend. And the second strategy is the breakout with confirmation entry strategy. So the breakout strategy involves waiting for a breakout and then a retest to confirm the strength of the move. So in this chart, you enter a position at the circled point when the price breaks above or below a defined support or resistance level with significant volume. So once these critical levels are broken and with high volume of buying, it is a confirmation that price will likely continue moving in that direction and will lead to big price movements. This way, you can ride the wave of volatility and maximize your gains. And the third strategy is using indicators like RSI, which is the Relative Strength Index, or moving averages. So indicators like RSI can tell you if a market is overbought or oversold. Overbought signal suggests that short-term gains may be reaching maturity point and may be due for a price correction, while an oversold signal, on the other hand, suggests that drops in prices are reaching maturity and the asset may be ready for a rally that is moving back to the upside. And for moving averages, which can either be the simple moving average or the exponential moving average, tells you the direction of the price trend using different periods like a 20 days, 50 days, or 200 days moving average. An upward slope indicates a potential uptrend and suggests that the bulls are in control, while a downward slope suggests possible downtrend and indicates bearish sentiment, meaning that the bears are more in control of the market. So at the end of the day, your patience pays the most. Now let's look at some real life examples. So in the 2021 bull run, Bitcoin's price rallied to an all-time high, rising by 1,551% after a 73% drop in price from 2019 to the low of 2020. And from the low of 2020, there were 5 pullbacks, all greater than 20%, before reaching the high of November 2021. Another example is in stocks. And if you look at stocks like Apple, for example, from its low of April 2024 to its high in January 2025, that's an increase of over 58%. There were 7 pullbacks ranging from -3% to -13% before getting to its high. And each dip was a smart entry and buying opportunity. So if you're wondering when is the right time to buy in a bullish market, well, now you know. You don't buy at the top. You wait for structural confirmation or a healthy pullback. And I'll see you in the next video.